Hey everybody, and welcome back to H Invests. Very excited for this presentation because it's our very first stock analysis video. So today we're going to be covering Lockheed Martin. I'm sure many of you have heard of them. If you haven't heard of Lockheed Martin, you're probably familiar with some of their products and kind of what they do. But if not, hey, that's what this presentation is for. So this is the very first one. I'd be really interested to get your guys' feedback in the comments. Let me know what I did well and what you'd like to see more of in the future so that I can adapt this style of presentation. Disclaimer as always, I'm not a financial advisor. This is solely for educational purposes. And when investing, you're taking your own risks and it's your own liability. But yeah, also let me know any questions you've got and we can discuss. And any future recommendations for videos, please drop them in the comments. Right, so without further ado, let's get started. So, who are Lockheed Martin? So they're an aerospace and defense company, the third largest globally, both by market cap and by turnover. So the largest is Boeing. You might be familiar with Boeing from kind of the big 747, 737 airplanes that they make. Boeing do a lot of defense stuff as well. And also Raytheon, they're very similar to what they do in terms of Lockheed Martin's stuff as well. So Lockheed Martin, they've dominated the Western market for kind of high-end fighter jets. You can see an F-35 down here on the bottom right of the screen. That's what you can see there. And the main areas of focus include defense, space, intelligence, homeland security, and also infotech. So they're very diversified and also very innovative. You can also see the company breakdown on the left of the screen. They're pretty globalized, but what you've got to remember is that the majority of their revenue comes from the US. So that's going to be a very key point. Not only does the majority come from the US, of that US, the majority of it comes from the government. And then in terms of products, as you can see, they're pretty diversified, and their largest kind of turnover is from aeronautics, just about 40%. Okay, so you might be thinking, why has this dude picked Lockheed Martin to focus on for an investment presentation? It was primarily a bottom-up investment thesis. So what that meant was I was looking at the micro before the macro, and it kind of passed this very strict quality filter that I had for good, high-quality companies that are also paying out dividends. I've studied the macro environment, and that looks very stable, with the US government extremely likely to maintain Lockheed Martin's long-term defense contracts, and it's also cheap. So it's cheap from a valuation perspective. These kind of companies are very good to value quantitatively because you've got very stable cash flows coming in from the future. You've got these long-term contracts with the government. It's very easy for the company to predict what its cash flows are going to be. It's very easy for the analysts to forecast what the cash flows are going to be. So it makes these models quite relevant when you're analyzing the shares. And also, yeah, so that's basically it. You can see a helicopter that was made by Lockheed Martin that's also part of its aeronautics division. Okay, so let's start with the macro. So I mentioned that the US was a massive part of Lockheed Martin's revenue. So a very logical question to ask from here would be, how will defense spending change under a Biden administration? If you're watching this presentation, recently Biden has become the 46th US president. He's actually becoming president right now as I'm recording this. He's just about to get inaugurated down in Washington. So yeah, the key question, how will US defense spending change? Firstly, what I can say is the US has always been a very big country on defense. You know, it's always spent a lot on defense. And you can see the long-term trend here. This is in the past 100 years, if it's quite small for you to read. You can see the long-term trend is up. Clue for 100 years, yeah, you got the spike at World War I and the spike at World War II. But you know, in the recent past, you can see this long-term upward trend. Also, Lockheed Martin's products are unlikely to be significant if there is any cut in US defense spending, and I'll go through that later. Yeah, so long-term trend, no major cuts since the early 90s. And it's quite interesting actually because Trump was looking to veto a defense bill in December 2020, and it got overwhelmingly voted against. And I just wanted to kind of gauge the sentiment. And you can see here, for example, Mitch McConnell, who's the Republican majority leader, he said on the back of what this decision, it's the chance to ensure we keep pace with our competitors like Russia and China, citing efforts to invest in the military in order to ensure it was equipped to outmatch any adversary. So that really gives you an idea the US has to keep up defense spending. And this goes hand in hand with what's going on globally. So this is a really important point, is that China and Russia, kind of the two very, very powerful military countries in the East. Particularly China are growing their military very, very quickly. China have got this huge plan to expand their military rapidly by 2035. You know, and if the US wants to maintain its global force in the world, it's going to have to keep that up. So that's basically the general sentiment in the US. You know, can I say with certainty there's going to be a massive increase in defense spending? No, you can't. But given the current sentiment of what we're seeing here, there's unlikely to be a massive cut. Okay, so defense spending in the UK. This was another slide I added in to kind of support the point that I just mentioned. So here in the UK, we've just been given our largest military spending in 30 years. And this is actually, it's despite the government borrowing being at record levels. So with COVID, obviously the government have had to borrow huge amounts of money for all of the furlough schemes and to save businesses and to build new hospitals and do huge vaccination programs, and it's all cost a lot of money. But even then, with the UK very, very much in debt, military spending is still going up. For the first time in 30 years, we've seen a massive increase, and this is showing that defense spending must be a very important priority for the UK right now. Otherwise, we wouldn't have done it, right? We would have done it in some other time where it's like, right, things are going very well for the UK. Fiscally, we can now relax. You know, we can spend a little bit more in military, but we're doing it even at a time when the UK budget is not in such good straits. And okay, so Boris Johnson's comments on this. The international situation is more perilous and more intensely competitive than at any time since the Cold War, and Britain must be true to our history and stand alongside our allies. To achieve this, we need to upgrade our capabilities across the board. Oh yeah, okay, so what we're seeing here, we're seeing the very same sentiment that we're seeing in the US. He wants to stay on top of the geopolitical uncertainty at the moment, and hence we're seeing an increase in defense spending. I will say though, you know, this isn't solely, it might not be solely because the UK has got this sentiment. Like the UK's military, we haven't seen massive funding for a while now. And as you can see from this graph at the bottom left, defense spending has been pretty much flat over the past decade. Yeah, the last increase was in 2007, and that's when we were involved in the Iraq War. So it's not going to be, it's probably not all down to geopolitical certainty, i.e. the UK probably needs an increase in defense spending. It's a bit overdue. But given Boris Johnson's comments and given that we're willing to do it at such a kind of, you know, a time of such borrowing, it's clear that at least this geopolitical uncertainty is playing a big part in the UK's decision to keep defence spending up. And the reason I'm talking about the UK is that the UK has played a big part in NATO. It's very, very, its kind of sentiment is very powerful among the kind of Western allies. And you can see this from NATO. You can see how much the UK is spending as a percentage of GDP compared to most of these other countries. And also the UK is one of the largest economies in the world, meaning that its military spending total is one of the largest in NATO. And it just kind of, the UK and the US, we've always been very, very close allies. And if the UK's sentiment on defence is this, coupled with the US's defence sentiment being that, it's unlikely we're going to see a big cut. As I said, the UK isn't so significant because it doesn't make up such a big part of Lockheed Martin's revenue. But still, if the UK is so bullish on defence right now, it's a sign that the US is not going to be completely lax. We're going to go for a massive spending cut. Okay, so even with all this in play, if we do see a small cut, Lockheed Martin's revenue is very unlikely to drop. So we've got some research by Morningstar here, and they're a very high quality research firm, and for stock markets. And they say, in our view, Lockheed Martin is the highest quality defence contractor due to its prime position on highly prioritised programs, particularly the F-35, and the company's areas towards secular spending growth, especially missile-related and space technologies. We think that the market's legitimate concern for substantial fiscal stimulus in 2020 or to prevent medium-term defence spending growth creates opportunities for investors. Our view is predicated on opinions that the defence budget will flatten and not shrink. So what Lockheed Martin are talking about here is, you can see from this chart, we had quite a big decline in the share price in 2020. And they're saying that actually this decline, people have overreacted some sentiment there's going to be a massive defense cut, where really the research isn't pointing that way. So that's what they're saying. I just wanted to point out as well on here on this chart of Lockheed Martin, just so you're not confused, these two red peaks, they went along with the general market trend. It wasn't so much Lockheed Martin had a massive crash. Here we kind of had the fan correction where the stock market didn't do so well in the end of 2018. And then here in March 2020, we had the COVID crash. And it's interesting actually, because fundamentally, not much has changed from Lockheed Martin. But you can see the pre-pandemic level at $440, which is actually very similar to many fair value calculations, which I'm going to go over in the second half of the presentation, which is very, very interesting. Okay, so also, yeah, so in terms of turnover, you can see what I wanted to highlight here is the stability of Lockheed Martin's business. That's why I've got these graphs on here. You can see turnover slowly, incrementally goes up. There's very little variance in that turnover if you look at it. And also the EBIT. The EBIT's long-term trend is up, and it's consistently up. You can also see the profit outlook for Lockheed Martin. I think the one on the left is July 2020, and then the one on the right is October 2020. And great that the guidance has gone up a little bit. You can see the range on the left, 6.9 to 7.05, and now the range on the right is about 7.125. But the key thing is just like, you can see how little change there's been in predictability. Yes, slight improvements, and that's great. But the point is, Lockheed Martin, they know where their revenue is coming from these long-term contracts. Just an example of this long-term contract, the F-35, which I mentioned in the first slide, the kind of big fighter jet, that accounts for 30% of their revenue, and the contract is going to be sustained until the year 2070. This took 19 years from the contract award, developing the prototype, to actually the military rolling out and using it in 2015, which is very, very impressive. And it kind of shows you the long run work that's been built into this for the contract to be rolled out into 2070 is amazing. It creates a massive economic moat, which is what I'm going to go on to in a minute. Just on the macro, before we kind of dive into the meat of this presentation. So in summary, I'm not a geopolitical expert, but the 2 points that I wanted to run home is that US defense spending is highly unlikely to see any major contraction. You know, just a huge cut is very, very unlikely to happen. Number two, Lockheed Martin's turnover is incredibly well protected through long-term contracts such as the F-35 program. Okay, so on to the micro. Okay, so yeah, in the aerospace and defense sector, there is a massive opportunity for economic moats, which is kind of what I was hinting at on the last slide. A big one is switching costs. So these are very, very long-term contracts that these aerospace and defense companies have with the government. Well, the government are relying on them for a functioning military, right? So the government are very, very dependent on these companies getting them right. And if you've got a company that it works, you know, the machinery works, you've got people trained up in the military for this machinery, and everything's working and they can adapt to your specification, it makes very little sense for the government to take the risk and to change. Because if the new supplier is not as good, or gets something wrong, or doesn't meet the government specification, then the government have taken a massive risk, and then they don't really have the same kind of functioning military that they would have had as before. The other thing is the high startup costs. You know, if somebody gave you 10K right now and asked you to start up an aerospace and defense firm in your backyard, it'd be very, very hard to do that. It'd be much easier to set up a lemonade stand, right? Like, it's very difficult for the companies to find, new companies to find the capital for the factories and the raw material cost of the machinery. Specialized knowledge to design and build the machinery, that's a lot of money you're going to have to be paying somebody before you're even making any revenue. And also to build up a relationship with the government. So what this means is that a lot of these companies are quite old and they've been operating for a long time. I think Boeing's actually been around since the 1920s, Lockheed Martin 1995, I believe. But anyway, I thought it'd be good to give a kind of general comparison throughout the industry and see how Lockheed Martin's competitors are doing. So the first thing to kind of note, I've kind of put together some of the most important metrics that I think are good to look at when you're looking at aerospace and defense companies. So you've got high return on capital employed and high EBIT margins. These are two really, really important metrics to look for the prevalence of the economic moat. So return on capital employed, all of the capital employed to the business is returning a good EBIT, and also that EBIT is a really, really high margin of the sales that the company is turning over. So those two looking high are very, very good signs. A lot of people might ask, like, why are you seeing so much variance between some of these? Like, for most of them, the return on capital employed is slightly higher. For some, the EBIT is higher. If you look at TransDigm, for example, you can see they've got a very, very good EBIT margin, much higher than anyone else. But their return on capital employed, much more average, right? What does that mean? Why is that happening? The problem is that, like, the EBIT margin, they could be leveraging their position, taking on loads of debt in order to help with that margin, because it's before any interest that has to be paid. But so you can actually see, if you look over here, their net debt to EBITDA is 6.7 and is much higher than most other companies apart from Boeing. And you can also see their interest cover is very, very, very low. So what this means, like, this interest cover of 1.7 is nuts. It means that almost 40% of their earnings before interest and tax is then being taken off the interest. So their net profit is almost half of what their EBIT is, just because of all the interest they're having to pay on their debt. And that's not a safe position to be in at all. Because what if you had a really bad year, right? And your earnings went down, your interest cover is getting less and less and less. What if you had to take on even more debt? You can't take on more debt with the opportunities, because then all of your EBIT is going to be taken up by interest payments. And then how do you pay off the debt if you're not earning any money? So yeah, I mean, that was a bit of a side story, but it's good to see Lockheed Martin's return on capital employed and EBIT margin at a very, very high end of the spectrum. Their turnover, again, is good. It's kind of in the mid-pack, but it's good to see it this is compounded over 5 years, so consistent turnover growth. It's good to see the industry growing as a whole, to be honest with you. Just a side note on the other metrics, you can see that the EBIT margin, not only is it high, but it's been improving over time. Same with return on capital employed, consistently high margins, very good return on capital employed, improving over the past 3 years in particular, showing that Lockheed Martin are getting more and more efficient as a business, and maybe the prevalence of this economic moat is actually getting wider. Turnover, again, I just wanted to show you how stable that is. The free cash flow, again, the growth is great. We want to see companies with growing free cash flow. And then the forecasted yield, I'll talk about this in the next slide, because I initially found Lockheed Martin through a high quality dividend screener. Asset turnover, this is a very important measure in these kind of businesses, because basically what that's measuring is it's measuring how much revenue can you generate with all of the assets you've got. How efficient are those assets at generating revenue? And you can see that Lockheed Martin has by far the most efficient assets. That basically means, yeah, this will translate to lower relative capex. It basically means, you know, you have to spend less on assets to get the same amount of turnover, which means when your operating cash flow comes back in, you're not having to spend as much on capex, and then you have loads of free cash flow. So it's a classic good business model like that. Net debt to EBITDA, great to see that that's low. Interest cover 12.7. Very, very, very sustainable. And also it's good to see that the sell side are bullish on the stock. I mean, that's always great, right? When you've got the average of 20 analysts with 29% upside on Lockheed Martin, that's great. They're joint first with Northrop. As you can see, TransDigm, which weren't doing so well with their debt position, are not as well favoured by the analysts. But it is good to see that the analysts are kind of bullish on the defense sector as a whole as well, because it shows that there's bullish sentiment on the macro. Okay, so next, the dividend screener. This is really kind of the meat of where this whole thesis came from. So it was one of 43 companies that passed my high quality plus high dividend screener out of 5,089 companies in the US. So as you can see, very, very strict. You've got less than 1% of companies that are actually passing this screener. And they ranked 11th highest with a forward dividend yield of 2.9%. I don't want to reveal everything about this filter, but you can take a quick look at the table. It kind of gives you a rough idea of what companies passed it, what I was kind of looking for. These are some of the metrics that I used. And you'd say, for example, I want a minimum free cash flow dividend cover of 1.2 or something like that. And then it would screen out all the companies. That's how it works. So why do I think dividends are important at the moment? This is a very, very central theme. So we've got crazy low interest rates. We've also got a load of baby boomers retiring, partly because of the COVID pandemic. Think about people like pilots, right? A lot of pilots are in their 50s and 60s. They had to retire early. And what they're going to be doing is they're going to be going to their wealth manager and they're going to be going, oh, I want to change this this strategy we had of more capital growth to income. I want to be living off my pension and my retirement and what I kind of built. And a lot of these investors, these wealth managers, these pension funds, they're going to be desperate for the yields because this is what their clients want. But they also can't find it because the interest rates are much lower than they were. So a lot of these income stocks, I think we're going to see them as bonds proxies, which is going to be very, very interesting. However, whilst the 2.7% yield and the forward yield of 2.9 is looking good, I don't think the 2.7 yield on its own is enough to raise the share price. It's not going to be the same kind of catalyst if a stock like Ultra that had like 8% or another stock that had 6% is going to be appreciating the share price. But however, it is a very high quality company, and having this nearly 3% dividend yield is just another little perk of holding such a high quality company. It also provides the market with some stability in the low yielding environment as we come into 2021. I think that was the other thing I didn't talk about in the last slide. Oh yeah, the beta. It's got the lowest beta out of all of these companies, which is very, very promising, because if the market's in a downturn, Lockheed Martin's stock price is unlikely to fall as much. This beta is represented over the whole past market cycle, so it's pretty accurate. Okay, now our favorite, we are on to the valuation. So I thought I'd quickly look at a dividend discount model first. I don't usually use these that often, just from the fact that the dividend payments, the increase in dividend payments looked very, very, very stable and consistent over the next few years. The way this works is that the sum of the company's value is down to its future dividends, discounted back to present value using a WACC discount rate. That's exactly what this is. Yeah, so the estimates in orange are the average estimates of the 20 analysts. And then I put in 6% growth for the next 3 years, and then I said, oh, we're going to keep seeing it growing at 5% until it kind of fades out with a WACC higher than 5%. So basically that's what it is. You see very, very consistent growth. You can see the variance in dividend growth is very, very low. There was a bit more of a bit more variance in kind of earlier years, but in the past 5 years we see very, 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 very stable changes in growth with a slight slowdown, but that's reflected in the analyst projections, which is what gives me a lot of confidence. And then I've put in 6%. With 5% long run growth rate, you then see a premium of 57%. So this isn't my prime method of valuing it by any means, but I think it's just an interesting comparison to see, just because we know, because of these long-term contracts and the stable revenues, the Lockheed Martin, they can predict their dividends with relative certainty. And also the free cash flow dividend cover is 2.2. So Lockheed Martin, they're very, very conservatively, only about 40% of their free cash flow is going back as dividends at the moment, which is pretty conservative. And if they wanted to raise that in the future, there is plenty and plenty of scope to do that. Okay, so I just wanted to do a quick comparison on with DDM to Raytheon. You might ask, why not Boeing? I didn't look at Boeing just because they're really, really messed up in terms of their cash flow position, and we don't know how long that dividend is going to be sustainable for. And they actually suspended it in 2020 off the back of COVID. So it wasn't very stable at all. And I did do this for General Dynamics as well, and they came out as undervalued, but just comparing it with Raytheon, who was a little bit overvalued, we can see again the dividend growth has been pretty consistent. There was a cut in 2016. There was this weird acquisition that for some reason they cut again. But anyway, based off the analyst estimates, there's, Raytheon looked overvalued compared to Lockheed Martin's undervaluation. Just to give you an idea, Raytheon is kind of the one that's closest to Lockheed Martin in terms of market cap. Okay, so the key question you've been asking, what about the cash flow statement? So here we have a discounted cash flow. Excuse me, that red circle should be circling that FY18. So this is a discounted cash flow model, a pretty simple setup, if I'm honest with you. You've got the cash flow projections from the analysts, again, very, very stable. You've got my free cash flow estimate, which was just 0% growth for another year, so just consistent. Again, the reason why I have confidence with this is that the cash flows are very predictable, and this time you can actually see it straight from the earnings call. This is what the CFO was saying. Operating cash flow projections, capex projections, free cash flow projections. And this is not what you usually see, because a business doesn't want to say all this information and then not hit it and then the share price to go down. the fact that again, it's the long-term contracts. The fact they have the long-term contracts, they know what revenue is coming in from the government from a long period of time going forward. They can quite accurately predict what this operating cash flow is going to be. If his projections were like, oh, we're going to make 4 billion here and then 9 billion here and then it's going to go back down to 3 billion, yeah, I wouldn't really trust it. But the fact that it's so consistent makes me trust the estimates a lot more. And the fact it was consistent with the average of 20 analyst estimates gives me a lot of confidence these free cash flow numbers are roughly right. Obviously, you want a margin of safety, which is why you don't want to invest when the upside is like 1%. But there you go. We've got 30% upside here with very, very accurate numbers. Yeah, so that's pretty much it. I'll quickly just go over so the free cash was in a long-term upward trend. I just wanted to go over FY18 because some people might think, what happened to all of the cash flow there? But basically what happened is, for some reason, Lockheed Martin, they filed for a much higher tax rate in 2017. And then when that actually came through to the cash flow statement in 2018, it got written off as another expense and their free cash flow is actually much lower. I should have put a graph of the operating cash flow up here as well, because that was very, very consistent. But anyway, that's exactly what it is. They paid an exceptionally high tax rate for whatever reason. It's not something I really am too concerned about. It wasn't to do with the business fundamentals, as you can see, because the EBIT is growing year after year. What I tend to do for the tax, if I'm seeing tax rates which are quite funny like this, is I just put 21% tax rate into the DCF, which is the current US corporate tax rate for about the next 3 minutes until Biden gets it. We'll see. But anyway, that was the current US tax rate at the time of this presentation. Low beta, which has really helped keep the WACC down. So low cost of equity, the equity is low risk. The average interest rate on the debt, about 4%. Moody's gave it a good credit rating, A3. I think that's upper medium investment grade. And then very conservative. This is then plugged into the company's only going to grow at 2% after the next few years, after the next 4 years. And it's still 30% undervalued. And remember what I said earlier about this, the share hitting 440. It was around that area before COVID came around and might have been fairly valued. It's very close to this estimate. And actually it's very close to the analysts' estimates as well, the average analyst estimates. So that's the free cash flow for you. Management, it's always very important to talk about management. So James Taslet, he has joined Lockheed Martin recently after a very successful 16 years as CEO of American Tower. And you can see just from the share price how he's managed to transform the company. Slow, consistent share price growth in American Tower over the 16 years that he was there. Very, very impressive. A few things I love about James Taslet. He started off with a career in the Air Force. So he's been on the military side and he kind of understands how that works. He's been in that environment firsthand. Studied at Princeton, so great university, shows he's well educated. He studied both engineering and international relations in his time, which helps for kind of both sides of the business, the government relationship side of the business and the technical side of the business. And also, this is much more of a subjective thing, but he's someone that you would want running your affairs. From my point of view, when you're on the earnings call, you kind of gauge people's general attitude, like where their best interests are. Like, I really like James's attitude and he was great at answering questions and explaining things, and that's something you want to kind of scout out. And he's also been on the Lockheed Martin board of directors for 2 years. So it wasn't just like, boom, you're plopped in this random company you don't know about. You've got your military experience, you've studied engineering and IR, and you've also been on the board of this company for 2 years. So I like James Tasler, good management. So that's pretty much it. So just to wrap up with this investment thesis here, we've got Lockheed Martin, high quality company that is growing and paying the dividends, yielding 3% pretty much. The economic moats I went through, switching costs and high startup costs. People always ask about the risks, which I went through. So one risk would be the US government cutting defense spending and reducing Lockheed Martin's contracts. I think that's highly unlikely to happen, but nonetheless, it's still a risk and nothing is ever certain in this game. Lockheed Martin not keeping up the pace of innovation, that's another risk. I think with a fresh CEO, fresh management coming in, I think that their innovation is going to be good, and seeing some of the products that they're rolling out is promising, but nonetheless it's a risk that they might fall behind some of the more innovative companies in terms of securing new long-term contracts. Negative momentum on the share price, this is something that's quite interesting to see, is that you've still got the share price below the 50 moving average and the 200 simple moving average as well. So you've seen a lot of negative momentum on the share price, and I don't think there's a huge flaw. Like, you don't know for certain. It's not like there's an 8% yield that's like capping the downside on the share price. So that'd be something to work out. Like, is it a great company? From the analysis of the presentation, I think so. Do you want to wait until there's a turn in momentum for the share price to buy? Maybe, depending on what your technicals say and how negative you think the momentum really is. But from a fundamental perspective, I've given you the evidence. But dividend yield, okay, this is the other risk, yeah. The dividend yield of 2.9% is not high enough to create a floor on the share price. So it's not high enough that income investors are going to be going crazy over it. It's a great dividend investment and great stable, but it's not going to provide that same floor that a 6% yielder would be, where people are so desperate for income they're using the 6%. However, 2.7% from a quality company is still a very fair yield. Again, in terms of the projections very stable and consistent from management, and also the valuation. So my DCF gave you 30% upside, but DDM gave you 57% upside, and also the average broker $4.26, so 23.4% upside. It gives me a lot of confidence that my calculation is similar to what the average of all of the brokers are saying, and also 25 to 30% is a great margin of safety. Yeah, so that's pretty much everything on Lockheed Martin. I really hope you guys enjoyed it and that first one went well. But you guys let me know what you think would be good to include these presentations in the future. Let me know any questions you have about Lockheed Martin in the comments, and also any ideas for future videos. If you want to do a stock pitch request, I'll be very happy to hear it. And if you think this video was good content and you enjoyed it, please smash the like button and support the channel. Thank you very much.